considering that last month we came in over 300,000 new jobs, right? The predictions and forecasts right now are that it will come in as a strong report again. Whether that will be 250 or 300,000, we'll have to see. But that is the current forecast. So I expect to see a strong jobs report with a little uptick possibly in the labor market tightening due to more people hitting the unemployment lines.
In this video, Gary Wagner, editor of The Gold Forecast, video newsletter for traders and investors, explores the latest meeting minutes of the Federal Reserve and uncovers their potential impact on the markets, gold, and the dollar. He dives deep into the likelihood of future rate hikes and analyzes the market's response to these signals. Join us as we gain valuable insights into the intersection of monetary policy and market trends.
It's interesting. The ECB held their annual forum in which he spoke on a panel with Lagarde and a lot of other governors and heads of the central banks worldwide. Everyone seems to be raising rates. Inflation is a global scenario. And the one thing that he said that kind of stuck out is we're not taking 2 consecutive rate hikes off the table. Right now, it's a very high probability that the next FOMC meeting will result in a 0.25% rate hike. I believe it's 88.7%, according to the CME's FedWatch tool. But then if you go out to September, it's only 17.7% that would be followed by yet another rate hike. So the jury is out about 2 consecutive rate hikes. Whether he said that he will do 2. And I believe that he most likely will stick to that doctrine. I don't think it's highly likely we'll see 2 in a row.
What would need to happen before the second rate hike for him to change his mind on the second rate hike?
Okay, there's 2 key reports that are going to come out prior to the meeting. I believe on the 7th is the jobs report. And that's been a very, very strong component that has affected core inflation. And core inflation is where they're having an issue. And then after that, we have the CPI report coming out, I believe, on the 12th. So both of those meetings will come out prior to the Federal Reserve holding the next FOMC meeting. Depending on those numbers, it will certainly influence the ultimate decision by the Federal Reserve as to whether or not they're going to have 2 consecutive rate hikes. I believe that a single rate hike is pretty much factored into the market and almost a no-brainer, so to speak. It's what he said, and I believe that's what will occur. Because when he talked about the pause, he said this isn't a significant move in that we're no longer raising rates. We simply want to have time to assess how well our tools have used to impact inflationary pressure, because there's an intrinsic lag between when we raise rates and when we see the outcome of those higher rates. So he made it clear that the pause wasn't a halt. He also made it clear that they're not going to lower rates this year, which leaves us the only option. He will raise rates. He said most likely 2. We'll keep him at his word. And whether they're consecutive or not, I don't believe is as important as the fact that they're going to raise another 0.5%, taking I believe we're at 5 to 5.25, which would take us to 5.5 to 5.75 in terms of Fed funds rates. Hawaii has a huge percentage of population that works in the service sector because our main industry is tourism. You also have the fact that we are in our summer months. So what we're seeing now could easily be seasonal, although we get visitors year in and year out throughout the entire year. This is our peak season. In fact, where I live, I can see planes landing over the water about 2 miles from me. Right now, they're coming in at about 5 to 10 minutes apart during the day. And so what happens is when we get into peak time, there's a constant flow of airplanes coming in. Tens of thousands of visitors are coming in on a weekly basis. And so that's going to remain strong. Of course, it's just picked up after the recession and all of the problems that we had a couple of years ago. And so it does seem to be normalizing, but it is very strong. The Japanese are a large percentage. China is filling out the gap there. But we have a lot of visitors from the U.S.
When we're talking about the labor market, that's what a lot of people are concerned about. Any signs of weakness over the next 2 quarters that you see, Gary?
Well, considering that last month we came in, over 300,000 new jobs, right? The predictions and forecasts right now are that it will come in as a strong report again. Whether that will be 250 or 300,000, we'll have to see. But that is the current forecast. So I expect to see a strong jobs report with a little uptick possibly in the labor market tightening due to more people hitting the unemployment lines. The problem we're having in terms of seeing gold have any kind of meaningful rise is as long as rates are going to be raised and the current level is absolutely an elevated level, that is difficult to attract investment dollars when you can get a 5% yield on a CD or a government bond. It's been a long time since fixed incomes were able to get that kind of attractive return. And of course, bullion is a non-interest yielding asset. And so because of that, it has a very hard time gathering momentum for there to be additional purchases. The other thing that you want to realize is the dollar has begun to have some strength again. That does make it, because it's paired in dollars, more expensive for foreign investors to buy gold. I just wanted to confirm that of the dollar index. And so what you see is that in the middle of the chart, those highs come in around 114, and the dollar had some extended weakness in which it went from about 114 down to just roughly 100. Over the last 3 weeks, we've seen it pick up. It's sitting at about 103 right now, and it doesn't have technical resistance till about 104.45. And the key is, as long as rates remain elevated and there is a very decent return on government debt instruments and even banking instruments, it does become an attractive avenue for investment dollars, because there's basically little to no risk on buying a 30-year bond or a 10-year note. And if you're getting a guaranteed return around 5%, and you're comparing that to potentially getting an 8 or 10% return in equities, but also potentially getting zero or a decline in return in U.S. equities, you're seeing a lot of capital move from stocks into the fixed income, but the equities are still exceedingly strong in certain sectors, specifically tech. Tech has been on fire. I think that the dollar is strong because the yields are going up, and attractive yields for treasuries, any kind of U.S. debt instrument purchased in dollars is going to be supportive of the U.S. dollar. I think this recent strength that we're seeing in the dollar is based upon returns at current levels, not in anticipation of further hikes.